So welcome everyone again to another webinar on the Web3 CFO Club. And today we're focusing on crypto taxation. Taxation, of course, is jurisdiction specific. So today we'll dive a little bit more on the tax considerations for UK and Switzerland. So for any CFO, before they decide to engage in digital assets in their day-to-day business of their company, a recurring practice would first be to speak with a qualified tax advisor. One of the first orders in assessing whether crypto transactions gives rise to a taxable event is to first identify the character of income, whether it qualifies as capital gains tax or rather income tax. An important distinction, as different tax rates would apply depending on that specific jurisdiction. So if you're like most people, you will agree that crypto tax filing is a painful exercise. You have to compile your trading transactions from multiple exchanges, wallets, and be cognizant with the relevant tax laws. So today we have two crypto experts who will be sharing their insights on, like I said, two specific jurisdictions, the UK and Switzerland. We have Monika Bezmalinovic, a partner from Coin Finance in Switzerland. And we have Jamie Nuttall, head of crypto tax at Myna Accountants. So before we even go through the agenda for today, I want to let the speakers introduce themselves and share a bit about how they're currently helping Web3 startups manage their crypto tax. Monika, would you like to start?
Yes, good evening, everybody. We are located in Switzerland, in Zug, in the so-called Crypto Valley of Switzerland. We are a small team of professional accountants which have been working in this area since 2018, and we are specialized on all topics related to accounting, taxation, VAT, structuring, setup, and so on, and domicile, whatever is related to setting up a new company or foundation or association. We are mostly being audited, full scope audits on all of these companies, and that's our USP, to bring the clients through the audit easily.
Thank you.
Welcome.
And Jamie?
Perfect. Hello, everyone. My name is Jamie Nuttall. I'm the head of tax for Myna. We're one of the UK's leading crypto tax advisory compliance firms around the crypto space. We deal with everyone from a small retailer who invests a couple of bits and pieces here and there, all the way through to larger exchanges. Personally, I've been in the space since 2017 in terms of crypto. I'm a self-proclaimed degen myself, if I may say so. I'm also a fellow member of the ACCA. So we're all qualified or on our way to be qualified at the very least. In terms of clients that we look after, there's not many I can tell you about, obviously. The ones that I do and can talk about is one particular group, the Bored Ape Yacht Club community in the UK. We are the sort of self-proclaimed in-house accountants and tax advisors for them. And another thing that we are dealing with a lot lately, which might come up later on, depending on what you guys would like to hear, is for those who are launching their own token, let's say, for example, whereby there is some form of token option agreement that these founders and startups and newer employees from the get-go tend to get offered, and the implications around that. That's quite a common issue lately and can have some serious tax consequences. So that's a bit of an intro from me, Jamie.
Perfect. Thanks, Jamie. So we'll go through the agenda quickly. Today we're going to cover capital gains tax and basically how do you choose a cost basis, income tax, and some of the common crypto taxable events that you have to be aware of. How can you different strategies on how you can optimize your tax position, and we'll end by speaking about some good practices for tax reporting and compliance. So as usual, for like all the webinars that we do, we'll take Q&As at the end. Of course, I have to give this disclaimer, like I do each time, that this webinar content is for general information purposes only. If you need additional tax advice, please feel free to reach out to our two experts today. I always like to share a little bit about, as a refresher, what the Web3 CFO Club is and what do we do for new members joining. And I see in the audience there's some attendees who are not members. So the Web3 CFO Club, it's a community of finance and operations leaders in Web3, created by Request Finance, and we mainly have two objectives with this community. First is to share best practices on Web3 financial operations, accounting, tax, treasury management, and then basically to allow yourself to network with your peers in Web3. Today we have close to 700 members in the club from companies you'll be very familiar with. So we spoke about the speakers, and lastly, just very quickly about myself. So my name's Umar. I spend my time managing the Web3 CFO Club, organizing different initiatives like the one we're having today, the webinar. We also organize in-person events. And I also spend my time on a side project called The Accountant Quits. The Accountant Quits, it's a platform basically to learn crypto accounting. We have a podcast, and lately we also launched a crypto accounting academy. So yeah, so that's if you want to learn more about that, please just feel free to reach out to me. With that out of the way, I'm gonna stop sharing my screen, and we're gonna start with the first question, which is, so the first topic rather is on capital gains tax. So most jurisdictions globally consider crypto as property for tax purposes. So gains and losses from the disposal of crypto would be subject to capital gains tax. You just calculate it as you take your proceeds from the sale, and then you would, less your cost basis, you would arrive at your taxable gain or loss. We can speak about cost basis also, like in this discussion. There are various methods. I'm sure the audience would be familiar with different methods for calculating cost basis: FIFO, LIFO, WACC. So I have a couple different examples laid out in front of me for the disposal of crypto that would lead to capital gains tax. For example, paying employees in crypto, or when you decide to buy for goods and services in crypto, when you're swapping your crypto, bridging, when you provide liquidity. So these are just common examples that people would be familiar with. So the first question is, what is in your specific jurisdiction, so the UK and Switzerland, what is the cost basis most likely being used? And secondly, are there areas today where companies come to you to seek recurring tax advice when it comes to engaging in digital assets?
I'm happy to take that first, Monika, if that's okay. Sure. So from a UK perspective, the first thing you want to understand, and I'm sure most people do already, but it's good to kind of recap very quickly. It is about the disposal, the initial disposal of the asset and the initial acquisition of said asset. So once we break that down and we understand that a swap between crypto assets is a disposal of one and an acquisition of another, we're already halfway there. Now, most people, much fewer than it used to be, but still some people believe in the UK it is only when you convert it to fiat when there is a taxable moment. That isn't strictly true. That is a taxable moment, but there could be plenty of taxable moments beforehand, i.e. the disposal of Ethereum for Cardano, for example, of Polkadot for Bitcoin. All of these are taxable moments. Now, the reason why I bring this up when we're talking about the cost basis is because once we understand that and then combine that with, in the UK, we don't have LIFO, we don't have FIFO, we have a Section 104 pooling mechanism. So that's where everything in the single day that's of a similar or the same transaction with the same asset would be pulled together everything within 30-day window would be pulled together, and then everything else. So once you understand those two fairly basic concepts within the tax and accounting space, the actual base cost of the disposal later on kind of falls in place in itself. Now, in terms of how you calculate that, it can be a long and strenuous task depending on what type of transactions are going on. The easiest way to give yourself the best start is by using software. There's plenty of software out there that will help you eradicate a lot of these problems once you understand those fundamentals around the crypto and tax space. So that's my comment on it, really, as a good sort of starting point, really.
Yeah, from the Swiss perspective, we have a lot of advantages. We have a lot of freedom in evaluating cryptos or in general assets. And what we can do in Switzerland, what is very specific, we can create hidden reserves. So if we have, mostly we use either the weighted average costs, or we use the daily rates of the prices. So we can even on the wallet basis, we can work on that we have wallets which are weighted either or. So if we trade with a token, it's the same like Jamie said. Most people think if I exchange token, it doesn't trigger any capital gains or losses, but it does, because we have to declare the assets in Swiss francs. So every exchange of token triggers a value in Swiss francs. And the advantage is if you have those tokens low valued, so we consider it like inventory. We take the average purchase price, and then if I go and pay invoices, subcontractors, or I buy other tokens, it triggers capital gain. But at the end, I can still devaluate end of the month or end of the year to the average purchase price, which keeps me hidden reserves. And this is a very big advantage in Switzerland, which is not if you go abroad, IRFS and so on. And that's what, yeah. And I always try to explain it very simply. If you have an invoice of $5,000 and you paid by token, the value of the service is $5,000. So you have to, in this moment, the token that you pay has a value of $5,000, and you have to book it accordingly, even though you bought this token for $1 or whatever, you know. So it's sometimes very difficult to explain, but once the client understands the mechanism, they know how to treat it. And if you have token which you don't use either for trading or for paying somebody, you can keep them separately in a wallet and evaluate it in a very low way, this average purchase price, which is towards the taxes is a very big advantage, beside of all the other topics we will discuss later related to tax rulings and so on.
Jamie, you wanted to add something?
Yeah, it was just very interesting to see what the other side of, in what terms of what Switzerland does and how it operates there, because it seems like it's very similar, but you have a slight advantage there as well. What we do at our firm, at the very least anyway, is we tend to take the spot rates at the time of transaction, as they would theoretically be the most accurate. The real question isn't about that from my perspective anyway. The real question is which software is pulling the better data, because all the data comes from different sources online, and there will always be discrepancies. Now, much like with the if you're taking a spot rate, say using HMRC's monthly average, end of year average, you could look online for a different figure. That can happen. So which one should you take? The answer is, I don't think anyone really knows which one you should take, as long as you're taking the best steps and courses of action to make it as appropriate as possible. And that's what these software do really. They kind of help you with that.
We are here also very free. We just take, for instance, CoinMarketCap prices, the end of the day prices, and then we declare it in the notes of the financial statement, and it's accepted like this. And the same you mentioned before with the pot system. This one we use if we have a lot of transactions and it's exchange of token on a very often basis. So for instance, if we have automated services which are only trading, so we also use this pot system that we evaluate also with a daily rate of the current situation.
I want to stay on this topic, but then ask you about stable coins. So if a company, let's say they want to pay their contractors or buy goods and services using stable coins, so given that stable coin would be pegged to like a dollar, this in essence would not trigger a capital gains or loss event, if I'm not mistaken. Now, but let's say if someone like has to pay, for example, 1,000 Swiss francs or 1,000 British pounds, but they're using USDC, there's a difference in rate. Would that then trigger a capital gains or loss event?
Yeah, so from the UK perspective, that certainly would. There will be a discrepancy. We know, without going too much into politics, we know what the UK pound has done recently in the last couple of years, and that certainly would affect the prices and therefore would be a capital gain or loss. Just because it's pegged to a US dollar doesn't really make too much of a difference. If obviously we're talking about something that's pegged to the pound, then it would also be subject to the same rules. And the difference would be absolutely minute. In most cases, might not even show up. So yes, it can create a gain or a loss, and don't think it wouldn't, and don't think it wouldn't be subject to tax. It's the same rules, despite it being a stable coin.
In Switzerland, we treat stable coins like fiat, so it's neglectable. I mean, if you take a USDC or USD, it's the very same. We have monthly tax rates, so we have to use those because it's related to the VAT. So when we pay invoices, it triggers VAT, and the tax authority is giving every month the fiat rates against the Swiss francs, and we use the same rates for the stablecoin.
Wow, I didn't know that. Also, people listening right now, if you have any questions, please feel free to drop them in the chat bar. We can take them as we go along. If not, we'll take everything at the end. I just have a follow-up question on this is a little bit more accounting, but as per IFRS, crypto assets can be classified under inventory when basically they're held for sale in the normal course of business. And if not, they would be classified under intangible assets. Would that affect in any way the tax treatment, whether they classified under inventory or under intangible assets?
In Switzerland, you are absolutely free where you put them. Sure, if you trade every day, you cannot put it in tangible assets because it doesn't make sense. But at the end, for instance, especially if you had a TGE, and you create token which have no value at the beginning, you put them into intangible assets, and then you have a huge amount of hidden reserves during the time, and you only touch them if you really need, or you just change them into the current assets or inventory if you need to trade them, and then you trigger capital gain, and you can keep this for a very long time. And the way the price is developed, it's a very big advantage tax-wise.
So from our perspective, the first step is to determine what is the use of the crypto asset itself. Is it genuinely an inventory type asset? Is it perhaps a native token? Are we trading? Are we investing? Is it used as stock, for example? It really does depend on what you're physically and actually using it for. And then from that point, you can go along the usual courses of action. One thing, yeah, that's pretty much it, to be honest.
Perfect. Next topic is income tax. So there's a lot of examples where crypto then would be considered as would fall under income tax. For example, I will list just a few: income I'm earning from mining, for example, or staking income, my liquidity pool income. If I'm receiving crypto as compensation, I mean, there's a lot of examples. An airdrop, for example. A lot of them, again, will be jurisdiction specific if that crypto income has to be taxed or not. But I want to ask you, so in your jurisdiction, where would you say the tax guidelines are very clear? And other possible areas maybe where it's a bit ambiguous right now and maybe not aligned with other jurisdictions that you're aware of?
In Switzerland, let's say the direct tax is very clear and simple to handle. And the bigger problem is with the VAT, because the system is a bit slow and it takes them a lot of time to focus on the various derivatives, let's call it like that, and to learn about the system. I mean, it took them like 2 or 3 years to even realize that we have a new system, the blockchain, and what it is and how to make the regulation. It's a very slow process. So the direct tax is very easy because usually you discuss it with the communal or with the city taxes, first of all, in Switzerland. But the VAT is a federal institution and it's very difficult to get in touch with them or convince them of certain approaches. Mostly we do best practice, and so far it always worked out with the VAT, but this is the most important thing because the VAT declares how am I going to classify the different ways. So mining, for instance, is revenue, staking income also. I mean, staking revenues are maybe in a classical way are more like interests, but this is a totally different thing regarding VAT, and in Switzerland they are considered as regular income. And so we have to really focus on VAT, and usually it's not very clear how to do it. So best practice and a lot of experience is very welcome here.
Yeah, it's slightly different in the UK in terms of we also have fairly straightforward guidances at the moment that kind of pave the way as to what is considered income tax. For example, you've given us staking and mining very clearly under the income tax regime. Airdrops too, some of them can be tax-free. That's a bit of a niche area that some people do tend to forget. Rewards, same thing, loan interest, a whole lot under the income tax regime. The important thing to remember is the first one is, although staking, as Monika has pointed out, is very similar to interest, it is not considered interest, and therefore you don't get your interest-free tax amount that could be allocated to it. However, you do have something called trading income. Now, trading allowance is £1,000 tax-free, as I'm sure many accountants listening would understand that, but that is also allowable against miscellaneous income. And miscellaneous income is where you would put all of these as a default position on your tax returns. The only difference is if it is fundamentally a sole trading activity. So this is where we would apply the badges of trade, for example. For those that don't know what that is, if you Google it, it will come up. It's fairly straightforward. And you have these 9 questions that determine whether it's a trade or not. And once we discover it's a trade, that's when national insurance starts to become applicable in these situations, and it becomes a standard self-employment type exercise. The one thing I would like to add to that for those that are trying to determine if it's a sole trade or not in the UK is I would add one more question to that. And that would be, what is the level of sophistication in terms of the activity that you are carrying out? For example, Monika might be mining, fine, not a problem. That will come under the miscellaneous income section in most cases. Uma, you might be trading every now and then, absolutely fine. Probably under the capital gains tax heading. But when you ask the level of sophistication, and it transpires that I, for example, am, let's say, dealing with bots, algorithms, very high level of complexity compared to the average person, that's an added string to the bow of perhaps it's actually self-employment let alone miscellaneous income. And just to reiterate, the difference is your national insurance.
Yeah, I would like to add to this quickly. It depends what is the aim of the company. If the aim is, for instance, I have a client, it's a gallerist dealing with NFTs. So even on the purchase of NFTs, I have to book the VAT, which in a case of another branch of company, purchasing an NFT maybe as financial investment and keeping it in the books, I'm sorry, it doesn't trigger VAT because it's a financial transaction. So it's very important to look into the aim of the company and to get the strategy defined before you start with the accounting or before you talk to the taxes, because you have to know what you're doing and what kind of miscellaneous actions will take place beside of your main or your core business.
Are there then some gray areas today that you notice that's an income, but we're not really sure how it should be taxed?
The most common one is probably airdrops, when people think, did I know this was coming? Did I do something in order to receive that? Now, regardless of what it is, it's going to be under the income tax regime, but it's whether it's taxable at the point of receipt. And that's probably the most common one, and I don't think it's particularly difficult in the grand scheme of things, but it is the most common. The other one is whereby if someone were to do simple transactions and it's just a lot, and they happen to make lots of money through simple transactions, that a lot of people would think, oh, actually, that could be a trade quite easily. When you actually put it on paper and you look at the badges of trade and the actual function of what this person is doing, just because it's a high level of frequency, that is not the only criteria. So I would say that that would be a gray area if someone were to be trading a lot and making a lot of money and it's inconsistent, but they're not using bots, they haven't taken out a loan, they've got a little bit lucky. At what point does it become trade? Does it ever become trade? You'll need a lot more detail, a lot more information. And again, the badges of trade within the UK is a great starting point and would be wonderful evidence for when you do take it to HMRC one way or the other. And if they ever query it, that's the first thing I would go to in terms of a backup and a justification of what you have decided, because to be honest, it is subjective.
Yes, and I think what is very important that the accountant has technical knowledge, because if you don't understand the system, you don't know what to do. I always consider myself as the translator between the classical authorities and the new technology, and I have to understand what is the reward, what is the airdrop, what is mining, and so on, to be able to translate it and to declare the figures afterwards. And that's why involving an accountant in Switzerland is actually quite important, but it's being neglected because accountants are not really considered as important. So mostly, new companies or people that want to create a new company, they go to a tax advisor or to a lawyer and so on. But and they start doing whatever they're doing, and after a year, when they get the deadlines for taxes and so on, they come around and say, "Oh, I have to do my accounting." And then we see that the whole setup is not really tax favorable. So
it sounds like you get the exact same problems that we're having. It's worldwide. Do you find your clients also have a situation where they come to you and say, I have all this in the company? Excellent. What steps have you taken to ensure that that wallet address is owned by the company? Because the KYC is in your name, or there isn't any KYC. Who owns the keys itself? I assume you get the same issues that we have around that.
Yeah, I mean, sometimes even the wallet inventory is a challenge. You know, and it pops up when we have transactions and things are missing, and they just think, how can we know that something is missing? But with the time you see it, and sometimes they always think we are just trying to be mean, but the first thing is, as you said, you have to get those wallets together and see how you want to set it up in the beginning. If you start mixing everything on one wallet, it's going to be a pain and it's going to cost a lot to get things apart.
I would agree with that being one of the greatest advice we could give our clients, is to segregate the wallets appropriately. Even if you have a wallet that you share with a friend, that little tiny detail there can change everything.
Yes.
Because when you're using software to amalgamate the data, it kind of nullifies it just a little bit and everything is thrown off. So I'm really glad you're going through the same as we are in the UK.
And it's very easy to give some structure in the beginning, also the filing and so on. I mean, all these transactions, if a client comes around and say he doesn't remember what it was, so what can I do with this information? So I try with the new companies, and I'm happy. In the last 2 years, people are coming before they create a company and ask, how shall we do it to make our lives easier? And then we help with structures, filing, labeling, and explaining that we are not Panama, because there are people thinking we are Panama. So we have regulations, we have taxes to pay, and we have to deliver financial statements.
Just to add to that, before you move on, with regards to those that are setting up businesses right from the beginning, I cannot actually emphasize how important that can genuinely be. Touching on something I said at the start of this particular webinar, is for those who are creating entities whereby you are rewarding your employees and staff with tokens in exchange for their service. Now that's fine if there's a cost basis for that token at the point of receipt. Excellent, fine. But what I see a lot of, and I don't know if you do as well, I suspect you probably would, is where they go, oh, this token is launching, we'll give you X amount over time, but the cost will be zero, so you don't pay any income tax, and then you just pay capital gains tax on it. And we go, whoa, hold on. That sounds like a share option agreement type thing, but that needs to be qualified by HMRC. These token option agreements, as I've called them just for now,
Yes.
is you can't get that qualified by HMRC, which means you can't lock in the original cost, which in most cases would be around zero. And therefore, at the time of receipt, when everything's going well and the market's going up for that particular company and that token, they're going to get a big tax bill, regardless of what their contracts say. Their contracts could say it's zero,
Exactly.
doesn't matter.
And you have to sell the token to be able to pay the taxes.
Exactly. And if you sell too much, you might tank the market. You might have another clause that says you can't sell it for a while because it will affect the market. So absolutely spot on. Get someone at the start of it, even if it's a 1-hour consultancy, and it will save you an absolute fortune in the future.
That's correct. I mean, if you consider it like, if I get any kind of token, what can I do in this moment? I can sell it for a certain price. So for me, it's very logical that the value of this token is the daily price and not something that was agreed before. And here you even have to pay Social Security on it and so on. So people are not aware that is like a salary component.
I want to continue and speak a little bit about strategies to how companies can optimize their tax position. Again, we already gave a disclaimer in the beginning of the webinar that nothing should be construed as tax advice. I want to ask you, so how should businesses approach the subject of tax optimization from the time of structuring until the time of filing? We spoke about choosing the right cost basis. It seems like, so in the UK and Switzerland, it's pretty prescribed, the cost basis that you have to use. But I also want to touch on other strategies, like, let's say, tax loss harvesting, which essentially means to sell your assets in a loss position and then net those losses against the gains from other disposals. There's also wash sales trading, which are still allowed today in many jurisdictions. Could you basically do us run through some of the recurring tax strategies that companies are using for crypto to optimize their tax?
Jamie?
Yeah, sure. So tax loss harvesting, going back to that's a very, very powerful tool. There's a slight difference between wash trading and tax loss harvesting. In the UK, remember I talked about the Section 104 pooling, where you've got the 1 day, 30 day, and everything else. So what that means is if you were to dispose of an asset to crystallize a loss because you bought it for £1,000, it's now sat at £100, you could probably claim that if you dispose of the asset. Perfect, wonderful, great stuff. Why not? Especially in the bear market where those opportunities arise. The problem is you might not want to dispose of it. So what can you do? Can you sell it and buy it back? Yes, but only after 30 days, because that asset might be actually brought together and negate that particular transaction. So tax loss harvesting is very powerful, but you have to be very careful with that. The second thing I always want to talk about is when you're incorporating a business. So the initial stages of incorporating. Now, if you do so with crypto assets on your person, and it's not a trade at the time when it is with you, okay? So you don't get what is known as incorporation relief. If you were to incorporate your assets, it's considered, in some cases, a disposal into the limited company that you've just created. Again, if you did this in a bull market where everything is going up and up and up, your tax bill is going to be there and it might be quite high. However, if you did it in a bear market or towards the end of a bear market, beginning wherever, you would end up in a position where you're more than likely have a little tax bill, if any, and you might even create a loss. Therefore, you have tax harvested and incorporated if that was part of your business plan in the first place. The final thing in terms of tax planning about all of this is a very, very simple one. It's so simple, everyone will understand it, but I tell you, I promise you, is the most important, and that is to put your money away for taxes. Now, this is not financial advice, it's not even tax advice at this stage, but when I talk to my clients, I tell them, when you receive income, whether it's self-employment or whether it is for a limited company, put your money aside away for taxes. And that's outside of crypto. So why is it more important? And I mean it more important with crypto. Because if you keep it in, let's say Cardano, let's say Bitcoin, the actual fluctuation of the price is much more dramatic than if you had it in fiat or even a stable coin. So by pulling out the amount of tax that you're expected to pay from that income and putting it aside, just like you would any normal tax advice, you're taking the risk, the market risk, completely out the equation. Again, I have to be very careful with what I say because it's not financial advice. This is practical business advice on what you want to do, okay? And once you've done that, if it were to go up, you're gonna hate yourself and go, oh no, I could have made loads of money on taxes. Sorry, fine, it happens. However, if it goes down, so you've earned the income in a bull market and you pay your taxes later on when it's a bear market, you could be in a situation where the income of £1,000 where you owe, let's say, for example, £200 in tax, but that asset which you have not disposed of, call it Bitcoin, is actually now worth £100. So even if you liquidated all of your assets to pay the £200 tax bill, you have come up short. So you're actually £100 down in your back pocket in that scenario. Now, you might think, oh, Jamie, come on, that's a very convoluted way. What are the chances of all that happening? Talk to anyone in the UK who is in business, and I promise you, a lot of them will be in that position where they go, I made that mistake, and it's just absolutely ruined their tax year because of it. So what can you do if that happens? Nothing, realistically. I know it's horrible. You genuinely can't do anything. So it comes back to what we mentioned earlier on by Monika, by Umar, and by myself. Talk to a professional when you first start. When you first start in your self-employment, when you first start with your limited company, maybe when something changes, pay the money for even an hour if you don't have a consistent accountant to get that advice around how it goes about it. Now, you can't go to any accountant. You have to go to Monika or myself or someone who actually understands the space and are in it ourselves as well, and are, as Monika said, translators between the government and what they want you to do and what you want to do as an investor or trader. Okay, so 3 very crucial tips where the last one is so simple yet so complicated at the same time.
I just want to add to this, don't go to a lawyer because they don't help you. They just bill you. That's my experience. Sorry.
I've quite good
offense.
experiences with a couple of lawyers, but the rest of them, you're absolutely correct.
Okay. In Switzerland, I have to explain a few things. The first wash sales is not that common here because we have a lot of deadlines which we can postpone. So our clients are mostly not really interested to make the figures very quickly because they are not forced to. So the first deadline of taxes is September of a closing year, after a closing year. That's the first deadline. And you can extend it up to summer next year of the following one. So if we wanted to make these wash sales, you have to be very quick and also to follow the markets and so on. And I don't know how risky people are to sell something because the market can also go up and you don't have your token anymore. So related to taxes, I also want to explain in Switzerland we have 3 authorities. The federal taxes, which is for everyone the same rates. Then we have the cantonal taxes and the communal taxes. So it depends in which city your company is registered and in which canton it's registered. And it can happen that the village next to you has much higher taxes than yourself. And the same with the canton. For instance, you're in Zurich, you pay much more taxes than you pay in Zug or in Lucerne. As I said, even the next city has different taxes, but the federal ones are always the same. So in this situation, it comes again back to your aim of the company. We have a lot of foundations which were open source intended and didn't intend to make any revenues. And we can speak to the taxes here saying, listen, we don't have any revenues. We will just have costs because we are founded by grants and so on, or by the community. Can we find an arrangement that is a win-win situation? Because if we have only losses, the tax authority doesn't win anything. So in the past, there were, especially in our area, there were tax rulings which are actually in favor of the tax authorities and not absolutely in favor of the companies. So they agreed on a cost plus basis, for instance, cost plus 5, and the basis of the taxes are related to the costs. So it doesn't really matter if you have gains or not. And it allows you to create provisions, or earmarked provisions for the protocol, for instance. Nobody expected that all these prices will go up and you create capital gains. Nevertheless, if you have a tax ruling, it's mostly for a few years, and the tax authority can rely on to get a certain kind of amount on taxes. And these days we can see that it's in the advantage of the companies because most of them had a massive capital gain on these token prices. Nevertheless, we have the system of impairment in Switzerland. So it's not true and fair value. You can devaluate your assets almost to 0 if you have a reason. So you carry on all these hidden reserves, and it's common and allowed in our regulations. And this is very unusual comparing with other countries. So many have a tax ruling here, especially in Zug, which is really a win-win situation, and that's maybe also one reason that many companies are here. But nevertheless, I think you have, especially if you have a TGE, so if you create your own token, you have the advantage of low valuation and to keep it as intangible assets, for instance.
Wow. That was one of my next questions, but you've actually been answering it, Monika. I wanted to ask you, like, if someone in the audience right now is currently at the stage of thinking, so where am I going to structure my company? Like, for example, should I choose the UK or should I choose Switzerland? What are like the pros and cons of it? Maybe Jamie, if you can paint us like a high level summary of what, in terms of taxation for, let's say, a Web3 company, why would you tell them to come to the UK?
If I'm going to be brutally honest with you, Ma, and everyone else is listening,
don't come.
I don't see many people coming to me saying, I want to create a limited company in the UK. I want to be UK tax resident from a limited perspective. That just doesn't happen. The only time it happens is if they are trying to, if they need it to be for other reasons other than tax, which obviously can't go into because each is individual and personal. In terms of what actually happens if you are, for whatever reason, we've got a corporation tax rate between 19% and 25% on a sliding scale, depending on how much you actually earn. After that, you need to extract the monies from the actual company itself, and that will be on your dividend rates, and that will start from 8.75% all the way up to about 38%, give or take, depending again on how much you extract in any given year. On top of that, you can also have a salary, and we usually have a standard £12,570 salary for directors, and then top it up with your dividends. Again, all of this is standard, normal tax planning, nothing to do with crypto. The problem with this type of thing is you could actually have a UK taxable limited company, even though your company is not in the UK. Now, how can that happen? Well, for example, if you were to have your board meetings in the UK, so all of the owners, all of the shareholders, all of the directors are in the UK, and you incorporate in, let's say, Switzerland or Dubai or wherever it might be, the UK tax authorities can turn around and say, actually, you're operating in the UK. Everything that's happening in the UK, it is a UK limited company in terms of tax status. Whether or not Switzerland or Dubai or Thailand or whoever or China, whatever they decide is mutually exclusive from what the UK have decided from that. It hasn't come to it, but I'm certain there'll be situations where there's going to be lots of arguing over who has the tax and whatnot, and double taxation treaties come into play. Maybe none of it comes into play. For example, I believe in China, I think earning money from crypto investing might be illegal, for example. So they might not want it to be in their country, for example. So there's lots of different issues around that. But like I said, realistically, would you want to create a limited company in the UK? Unless you have to, I don't see why you'd want to.
Perfect. I see the time's passing fast, so I have a last topic which I want to touch on, which is good practices for tax reporting and compliance. So during the webinar today, you guys went through the challenges with on-chain transactions. Like you mentioned, some of them are completeness, so being able to capture 100% of the transactions, which today, I mean, individuals would mostly, from what I understand, they would use a crypto tax calculator, and companies are using more subledgers, crypto subledgers. Also, just having proper pricing at the time of disposal, and so making sure you're using a pricing aggregator like CoinGecko, Crypto Compare, or an exchange, and then being consistent, right, with your cost basis. I want to ask you, in practice, what have you observed your clients getting wrong about tracking transactions from the time of purchase to the time of disposal? And I would suspect it's maybe not using the right tools, but then do you have some good practices to recommend before companies even decide to have crypto on their balance sheet?
What I observe is often that the people that are taking care of the operation internally, or even the technical side, they also are responsible for the financials and so on and so on. And then they have their talents, and that's whatever they like to do, they do it most. So if they are technical guys and they still have to do the financials, they just neglect it. And one day they come around and say, oh, I have a big problem. So it's mostly a big mess. I would say, even though maybe in the beginning you don't have that much money, it depends if you are not being funded by third parties. It's maybe, as Jamie said, reasonable to get an advice and just get some structure in it, which helps you, because the moment you pay an invoice, you have the invoice in your hand, and in this moment you have the most information, and you'd never want to come back to open this invoice again or search it. So you better take quickly the note, if you want, in an Excel sheet, and keep it and say, okay, this is the invoice and I paid it by this wallet and the amount was this and this. It's so simple, and nobody else has to look at this invoice anymore. And I really urge people to do it this way, because otherwise we have to spend so much money searching for these transactions that it's really a pain and it costs a lot.
Yeah, I would echo that final sentiment there. Looking for missing transactions and missing wallets as a whole is very common. Not because anyone's trying to hide anything, they just forget. You know, it's been years. Maybe they've come to you and they need several years. It happens. And to find that, most accountants who can actually deal with this type of work should be able to give you a good idea of what's going on and ask the right questions of, we see a frequent transactions to this particular wallet or these sets of wallets. Are they friends? Are they your wallets? Are they, what's going on here? Because it doesn't look like an exchange. It doesn't look like, and that's when we kind of start to dig this up. So in terms of best practices, I would break them down into pretty much 4 categories. The first one is software. Get appropriate software for what you are doing. Again, I'm not going to shill any software in particular, but some software is better for you because of what you do, not because of what your friend does or someone else. It might not be the most popular one. Some software deals with NFTs much better than others. Some software can't deal with rebasing tokens full stop. So why would you use that if that's the majority of your portfolio, for example? So software is one of the categories in terms of best practices, is getting the appropriate one. The second is understanding. Now, if you don't understand the crypto element of it, learn a little bit. If you don't understand the tax and the accounting element, learn a little bit. You don't need to know it all, just understand some of it and it'll go a long, long way. So understanding how to run a business, for example, understanding what your tax obligations are as an individual, understanding if it's self-employment or miscellaneous income. All of that will help. The third one, which is the most important, is data. Gather the data. Frequently save your data. How many people do we know have been subject to FTX and Celsius? That data, to a certain extent, is no longer available for a lot of my clients, at least anyway. At the time, they could have been. We might be able to rebuild it. But Monika, how much would you charge me to rebuild a whole new wallet from scratch?
Then it's called we are expensive, but it's, I mean, the client is writing their invoices by themselves. So the more they do pre-work, we don't have to deal with it. There were times that I wrote every client on December 31st, please take a screenshot of every wallet.
Exactly, and it's something that could save them an absolute fortune in the future. So data gathering is important, and part of that is another section, I guess, is consistency. Do you want to do that every week? Download your CSV files. Do you want to do it every month? Download your CSV files. Like, for example, we know that if HMRC have an investigation or compliance check against an individual, one of the first things they always ask for is the CSV files. Fine. Problem is, we use API keys for a lot of the work, and we know that the API keys and CSV files should marry up. Let's be honest, they don't. So there's already a mismatch of what HMRC want to see if there's an investigation and what we're actually dealing with. Is that my fault? No. Is it the client's fault? Not necessarily. It's just the type of exchange, and it's still a very juvenile technology in the grand scheme of things. There's going to be teething problems. So how do you deal with all of that in one simple, easy, beneficial top tip? Get an accountant. Because an accountant will help you through all of that, especially one that's worth their weight in gold. Get early in, get some consistent advice, Make sure you stay on top of things, and all of this will start to fall in line.
A follow-up question on crypto tax tooling. So there's a lot of tools on the market, and we don't have to like shill any of the tools. But what should like price cannot be the only element that one has to consider at the time of choosing a crypto tax calculator. What are some of the other aspects? For example, I'm thinking maybe that tool they already have an SOC report, they have an ISO 27001 report, which further down the line will be requested by the auditors, maybe, right? So just having more assurance on whether that tool or has adopted a good control environment and whether that has been tested and those are operating effectively. What would you say like companies have to consider when even choosing a tool?
I must say here, with our large clients, which are known on the market, they don't like to use those tools because if they close some wallets, you can find out who is behind. So they rather pay us to extract every wallet by ourselves and track it and do it directly in our accounting system, also possible by APIs, but they don't like to use these tools that are on the market just because of disclosure and data security.
Very interesting.
Yeah, from my perspective, it does depend on what the client's needs are. Like you said, if they are a startup business, I'm sure price is probably one of the most important things to them at the moment. If privacy is an important thing to them, there is at least a UK one whereby they don't keep those particular keys, information on their end at all. So maybe that's a no-brainer for you in that situation. Maybe you want something where your accountant can easily change things and adapt, and it's fairly malleable because you've got lots going on that needs changing. So maybe that's another one. So it genuinely does depend on what the client's trying to achieve, which it is a cheat answer, if I'm honest, but it's the truth. It depends what you would like. So it's a case of talking to those like Monika, like yourself, Umar, and figuring out, okay, what would suit this particular individual and why? What are their goals? Because everyone's different. Everyone has a different objective. Everyone is at a different point in their career and their business life that can significantly affect which software, which tool you're going to use.
I think two little points for maybe smaller companies or individuals. If the tool is giving you an option to add a document, for instance, the invoice on the transaction, or to label it with a comment, this would help a lot, because then you can see, okay, it was this and this contractor, so you can label it contractor AB, or you even add the invoice to the tool. This is very helpful. And I guess there are cheap tools on the market that enable these two components.
We've nearly reached the 1 hour mark, so I mean, we only have 1 minute for Q&As, but maybe we can just extend that to 5 minutes. And
that's fine.
Sure. Perfect. So I want to ask everyone in the audience, if you have any questions, please post it in the chat bar. I'm actually, okay, there's a section for Q&As that people have asked some questions. So Tom Mays has asked, what is the best jurisdiction to set up in, which is most favorable to crypto? I don't know if you have an answer for that. That's always complicated, right? To say one jurisdiction is the best.
On the assumption that this is favorable in terms of a tax perspective, then you're just going to be looking at sort of Dubai, BVI, Thailand, those that have low tax rates or zero tax rates. For an individual, again, it's different. You're looking for somewhere with low or zero capital gains rate. Thailand, Portugal was one with the non-habitual residency program, which I think is being removed soon. So again, which is the best? It depends. Individual, company, what are your objectives? Do you like the sun? Do you not? Do you like the nightlife? It's up to you.
There's another question.
Sorry, I just want to add, if you are seriously having a company, you want to have access and you want to have it close. So if you are within Europe, you have to find, I think it's not always in taxes. Maybe you have to live where you work, and you won't go to, I don't know, Iceland just because of the taxes. There are other aspects beside of the taxes also. So it's a trade-off somehow to see the other components. Or if you have a family, you don't want to go to a place where your kids don't have a opportunity to grow up and have a good education. So I think it's not only the tax rate that matters at the end.
There's a question from Katya who says, Jamie, get an accountant is the best advice ever. She's asking, what if you want to be an accountant? What would you recommend to start with? Maybe Katya is asking, are you guys recruiting? I'm not sure.
Yeah, I'm sure we're both recruiting. Towards the trade. But yeah, if you want to be one, it depends. I'm assuming you want to be a crypto accountant rather than a general accountant. My advice for that is to go down the usual path of understanding how accountancy works or how tax works, whichever vocation you're going to specialize in, and then start to look at crypto at the same time. Now, how do you learn about crypto accounting or crypto in general? Genuinely, and it's not advice in terms of financial advice or anything, but put a little bit of money into the space, a tenner here, $5 there, have a trade, have a look at what's going on there, figure it out from the insider's perspective, and then you'll be able to translate that into the accountancy and the tax element of that. Now, if you're really, really, really lucky, someone like Monika or my firm will be opening jobs for trainees where we can teach you all of that specifically while getting paid. Those opportunities will be more and more prevalent as time goes on. I'm sure you guys agree. Just because more and more accountancy firms are starting to attend things like this where they get it, understand, and then can offer pay in due course. So where would you start with that? Depends where you are, depends where you are in your career, depends where you want to live. As Monika said, you know, and in the country might get more opportunities than others.
And I think a very important aspect is curiosity. If you are curious, you can learn anything.
There's a question from Natalia. In Switzerland, for individuals, can tax authority treat crypto income as a personal income tax, not as capital gains?
Yes, as an individual, it is. You have to be cautious, because if you tend to make a lot of trades, and the income through these trades is higher than your salary, even though you're 100% employed somewhere, they can treat you like a trader, and then you have to, then it's like a self-employment, and then you will have to tax all the gains you are making. So you have to be cautious, and sometimes it's advisable to establish a company just for the trading.
Perfect. Maybe you can just take a last question, which is, Monika or Jamie, can either of you advise on setting up in Bahrain?
Not from me, I'm afraid, but what we tend to do with those who are trying to set up in jurisdiction that we don't cover is you'd set up with a local resident accountant, and then all the bookkeeping for the crypto element we would then be able to help with. So the actual setup itself, we wouldn't be able to help with. I don't know if Monika could.
I agree. Same here.
Perfect. I really enjoyed this discussion. I didn't see the time pass, and we already we exceeded the 1 hour mark, but that's okay. I want to thank both of you, Monika and Jamie, for coming today. I want to thank all the attendees. It was a fascinating discussion. Crypto taxation is always fascinating. So next time we'll be covering other jurisdictions. You guys can let us know which jurisdiction we have to cover next, or if you have any other webinar topics that you think we should cover, just feel free to let me know on Slack.
Thank you very much, and good evening, everybody.
And just a last question before everyone leaves. If someone has to reach out to you, to Coin Finance or Myna Accountants, and they need tax advice, how should they do so?
After you, Monika.
You can write an email. And
what's the email?
Easily.
Okay, I can share the email.
Shall I quickly put it
yeah.
there?
While Monica's doing that, in order to get in touch with Myna Accountants, simply Google Myna Accountants and you'll have our webpage on there for starters. If you like Twitter, we're on Twitter, look for Myna Accountants. If you want to follow me particularly, you're welcome to message me at Crypto Taxation. I do not give free advice on there, much to the MD's dismay, but it's on there. Where else can you find us? LinkedIn if you really must, but most people find us through Twitter or directly through the website. Myna Accountants. You Google it, we will turn up.
Perfect. I'm just sharing in the chat bar as well the Twitter of Jamie. That's the right one, right?
I can't see it. Looks like it, yep.
Perfect. All right. Thanks a lot, everyone, again, and I hope to see you guys soon.
Thank you very much. Bye-bye, everybody.